Let me ask you something that should genuinely disturb you. Every major financial regulator in the United States, the CFTC, the SEC, representatives from the White House, all of them walked in front of cameras this week and said, on the record, in precise language, that crypto is the future of American finance. They named the initiatives, they named the timelines, they named the firms, and when the market heard it, it went down. Now there are only three possible explanations for that. Either the market is fundamentally broken, or the institutions are lying, or, and this is the one nobody in mainstream finance wants to say, the crowd is staring at the completely wrong thing. Today we are going to decode exactly what was said at the Milken Institute Future of Finance Summit, break down the regulatory architecture being assembled right now in real time, and explain why the reaction you saw in the market this week might be the single most important setup XRP has had in this entire cycle. But before I get into the evidence, you need to understand something most analysts refuse to say out loud. The move is not coming because of sentiment. It is coming because of structure. And those two things have almost nothing to do with each other. Stay with me. Welcome back. If you are new here, this channel exists for one reason: to cut through the noise and give you the structural analysis that the rest of the internet won't. No price pumping, no emotional forecasts, just the architecture underneath the surface. Today we decode the signals that just fired in Washington, and we explain exactly why the market's reaction may be the most significant mispricing of this entire cycle. If this is the level of analysis you have been looking for, you already know what to do. Let me start with the mechanism that almost nobody in retail understands, and it is the single reason that price and news are moving in opposite directions right now. Institutions do not move on headlines. They do not move on price. They move on one thing and one thing only: legally documented, agency-level certainty that tells a compliance officer, in writing, exactly what their firm can and cannot do with client capital. That distinction is everything. Because for the past 4 years, hundreds of billions of dollars from the largest asset managers and custodians on the planet have been sitting at the edge of this market. Not because they fear the technology, not because they don't understand the opportunity, but because of one specific risk: legal reclassification. The nightmare scenario where a firm allocates $100 million to a digital asset, and 3 months later, a regulator redefines that asset as an unregistered security. That is not a paper loss. That is a regulatory catastrophe. That is personal liability for executives. That is potential criminal exposure for compliance teams. No institution in the world takes that risk voluntarily. Which means the gate has not been about price, it has been about certainty. And this week, the architecture for that certainty started to materialize publicly, in documented, on-camera, agency-level language. Here is what the acting CFTC chairman said at the Milken Institute. And I want you to pay close attention because this received almost no coverage in mainstream financial media. He described a coordinated initiative between the CFTC and the SEC called Project Crypto. The explicit mission: build a legal taxonomy, a formal classification system that defines with precision what constitutes a security, what constitutes a commodity, and what falls entirely outside both agencies' jurisdiction. That taxonomy is the legal framework that compliance officers have been waiting for. Because once it exists, the question of, can we legally touch this asset, has a documented, enforceable answer for the first time in the history of this market. And when that answer lands, the gate opens. But that is not even the most operationally significant thing the CFTC chairman said. He confirmed that within the next 30 days, the CFTC is actively working to bring perpetual futures, the dominant trading instrument in global crypto markets, back on shore to the United States. Right now, the majority of derivatives volume for digital assets lives offshore, in exchanges based in Asia, in Europe, in the Bahamas. That is not an accident. That is the direct result of 4 years of regulatory ambiguity that pushed institutional derivatives desks out of U.S. jurisdiction entirely. Bringing that volume home is not a philosophical statement. It is a structural change to where capital flows, where liquidity concentrates, and ultimately where price is discovered. That is happening in 30 days. And there is more. The CFTC has committed to publishing explicit guidance on what types of digital wallets and on-chain software systems fall under CFTC regulation and which ones do not. This might sound technical, but the implications are enormous. The prior administration weaponized this ambiguity. They pursued DeFi protocols, wallet providers, and front-end interfaces, calling software products, brokers, and exchanges to create a legal chilling effect across the entire development landscape. Billions of dollars in institutional product development froze because no legal team could sign off on what was safe to build. That era is ending. And when it ends, the capital that has been sitting in institutional dry powder, waiting for permission to move, will have nowhere else to go but into assets designed for exactly this infrastructure moment. And that is where the math becomes impossible to ignore. Now here is the section where retail investors always get lost. People look at the market cap and say, how can it go higher? Let me reframe the question entirely. The global cross-border payment market processes approximately $150 trillion annually, not as a projection. As current volume, the actual payments running today through SWIFT and correspondent banking networks that were built in the 1970s, slow, expensive, structurally obsolete. Now embedded within that system is an estimated $27 trillion sitting in what are called Nostro and Vostro accounts. These are pre-funded liquidity buffers that financial institutions maintain at banks around the world specifically to enable cross-border settlement. $27 trillion, sitting idle, locked in place, earning nothing, serving purely as a mechanical solution to a latency problem. XRP's architecture, from the design of the XRP ledger to Ripple's on-demand liquidity product, is built specifically to eliminate the need for those accounts, not reduce them, eliminate them. Because if you have a bridge asset that settles internationally in 3.4 seconds at effectively zero cost, you do not need to pre-park $27 trillion in 50 countries as a buffer. The buffer becomes the asset itself. Now think about that mathematically. Even if XRP captures just 10% of that Nostro-Vostro replacement market, just 10%, you are talking about $2.7 trillion of structural demand flowing into an asset with a fixed supply of 100 billion tokens. Of those 100 billion, approximately 57 billion are in active circulation, and exchange reserves, according to CryptoQuant data, are sitting near multi-year lows. Less and less XRP is available on open markets to absorb any significant demand event. This is not a Moonboy thesis. It is a supply-demand requirement built directly into the plumbing of the global financial system. The math doesn't care about Twitter sentiment. The math is the math. A lot of people find this channel right before the market starts to move. If you're one of them, stay connected. What we're walking through today is exactly the framework you need. Now let's talk about what is already happening. Not what might happen, but what is in live production right now. The SEC commissioner at the same Milken Institute event made a statement that most retail investors scrolled past without understanding its weight. He referenced by name the partnership between Ripple and BNY Mellon on tokenized bank deposits. BNY Mellon manages $47 trillion in assets under custody. That is not a startup. That is not a crypto-native experiment. That is one of the oldest and most conservative financial custodians on the planet, a 240-year-old institution, integrating tokenized assets in a live production environment. Ask yourself the only question that matters here. Does a firm like BNY Mellon enter into that agreement without absolute legal certainty, without compliance sign-off at the highest levels, without private conversations with regulators that you and I are never going to be invited to? No. They do not take that meeting without knowing what the regulatory environment will look like 18 months from now. They do not begin production integration while the outcome is uncertain, which means they already have the clarity that retail is still waiting for publicly. They positioned before the announcement. That is what sophisticated capital does. It builds infrastructure before the crowd arrives. And BNY Mellon is not alone. Grayscale has launched more crypto ETFs in the past 12 months than in all previous years combined. That is not coincidence. That is a firm reading the regulatory landscape, understanding what is about to change, and building product distribution infrastructure before the demand is legally permitted to flow. When you see a move like that from an institution with Grayscale's compliance structure, you are not watching speculation. You are watching positioning. So I want to ask you something directly, right now, in the comments. Do you think the institutions are already fully positioned, or are they still loading? One word is enough. Let me know below. Now let's talk timelines, because this is where patience becomes a structural advantage. In the next 30 days, the CFTC has committed on record to publishing guidance on perpetual futures for crypto assets in the US market. That is a direct liquidity unlock that brings the offshore derivatives ecosystem back into US jurisdiction and concentrates institutional trading activity here. That is not incremental. That is a pipeline opening. In the next quarter, we expect final guidance on digital wallets and on-chain software systems. That removes the single largest legal overhang that has kept institutional product teams and developer capital frozen for years. When that guidance publishes, the legal teams that have been sitting on wait and see shift to build and deploy. On the Clarity Act, and this is important, the bill is not dead. It stalled on one specific issue: whether stablecoin providers can offer yield to customers. Coinbase is pushing for it. The major banks are pushing back. But here is what retail is missing. That is a business negotiation, not a philosophical standoff. Business negotiations get resolved. And the White House, through Miles Jennings, their crypto policy lead from A16Z, is actively brokering a compromise. The acting CFTC chairman confirmed on camera that the White House has convened multiple working sessions in the past month specifically to mediate this dispute. Representative French Hill, the chairman of the House Financial Services Committee, stated publicly this week that if the compromise fails, Congress should return directly to the July 2025 House bill, the version that already cleared 294 to 134, with 78 Democratic votes. That bill already passed once. It has the votes. It can pass again. One way or another, stablecoin legislation is moving in this session. The pressure is too high and the infrastructure is too far along to stall indefinitely. And there is one signal that almost nobody is discussing: the CFTC commissioner's comment on on-chain markets. He stated that guidance for DeFi protocols, decentralized exchanges, and on-chain lending is coming in the very near future. When that guidance drops, every institutional DeFi desk that has been idle waiting for a legal opinion becomes operational. That is not an incremental unlock. That is a structural green light for an entirely new category of institutional capital. The fuse is already lit. But here is where the window becomes critical, and this is the part that retail consistently misjudges. Exchange reserves for XRP are not just low, they are structurally depleted relative to the demand that is building on the other side of this regulatory gate. CryptoQuant data shows exchange balances near multi-year lows, which means that the liquid supply available on open markets to absorb a significant institutional demand event has been quietly draining for months. Think about what that means mechanically. When the Clarity Act passes, when the CFTC publishes perpetual futures guidance, when institutional compliance teams get the sign-off they have been waiting for, the demand that enters this market will be institutional in scale, not retail, and it will be entering a market where the liquid supply is already constrained. This is not a prediction. This is a supply-demand requirement. The tokens available on exchanges at current prices are not sufficient to absorb institutional scale demand without a significant price adjustment. Once a token moves from an exchange into an institutional multi-signature vault, it does not come back to market for a 10% gain. It is gone. The accumulation window doesn't close gradually. It closes the moment the gate opens. The informed investors are already in line. The question is how many people in the crowd understand that they are standing at the entry point, not the exit. I know the market right now doesn't feel like that. I know the red candles are real. I know the frustration of watching regulators stand at microphones and describe a future that sounds inevitable while the price moves in the opposite direction is genuinely difficult to sit with. Let me be direct about that. The frustration you feel right now is not a signal that the thesis is wrong. It is the cost of being early, and being early in this specific moment. At this specific convergence of regulatory architecture, institutional positioning, and supply depletion, carries a cost that manifests as patience, not loss. The institutions signing NDAs right now are not doing paperwork for fun. The compliance teams building legal frameworks for digital asset allocations are not running theoretical exercises. The exchanges building infrastructure for perpetual futures and T+0 settlement are not preparing for a market that stays this quiet. They are preparing for the moment the gate opens. And they are not preparing after the announcement. They are preparing now. Because that is the only time preparation is worth anything. Being early feels exactly like being wrong, right up until the moment it doesn't. Here is where we are. The regulatory architecture for institutional crypto adoption in the United States is being assembled in real time. The CFTC and SEC are coordinating on a shared taxonomy that eliminates the legal ambiguity that has kept institutional capital at the gate. The acting CFTC chairman committed on camera to 30-day guidance on perpetual futures. The White House is actively brokering the final stall point in the Clarity Act. The chairman of the House Financial Services Committee has publicly signaled a fallback to a bill that already has 294 votes. BNY Mellon, the largest custodian on Earth, is in live production with Ripple on tokenized deposits. Exchange reserves are near multi-year lows. The liquid supply is shrinking. The demand building on the other side of this regulatory gate is institutional in scale and nature. The crowd is confused because the price doesn't match the narrative. But the crowd is always confused before the convergence. That is what makes the convergence valuable. The math doesn't lie, the structure doesn't lie, and the signals, for those of you who are actually looking, have never been louder. Now, I want to ask you directly, now that you have seen the full picture, what is the one signal you are watching most closely as we move through this cycle? Tell me in the comments. The answer tells me everything about where your conviction sits right now. If you want this level of structural analysis on every major development in real time, you know where the subscribe button is. I'll be breaking down the next phase of this as it develops. You want to be there for it. Stay patient, stay rational, stay positioned. In a market driven by emotion and noise, we thrive on data and composure.